So let's get some more perspective on this story and the broader economic outlook and equity outlook. Alan Nuckman joining us. He's Chief Market Strategist of Bullseye Option. Always nice to have you with us, Alan. And, you know, those headlines from the World Bank, just a reminder of the cautiousness we tend to see each and every trading day right now. What's your assessment?
Well, we got a lot to unpack here. So, number one, we haven't talked since the big bounce. So that's step one in the recovery. We've got that. We've got a couple more steps that are positive. But we talked before about it's mainly been the psychology that's been negative. Earnings were great. Forecasts for the future, we're still having earnings growth. And there are a lot of positives out there. But it seems like people are trying to talk themselves into a recession. And here in my travels across the United States, everywhere I go, all I see are help wanted signs. You can't get enough employees. Now, that's a problem that we've never, ever had before. And you just talked about Target having a unique problem in the fact that they've got too much inventory. Remember, we didn't have enough inventory. Now we have too much inventory. We weren't raising rates. Now we're raising rates. So everybody's turning, all these facts into fear for whatever reason.
You know, I think back to the lows of 2009, March of 2009. I would always have to pull out those numbers because you got to do the quick math on where we are, et cetera, et cetera, et cetera. And it looks like, you know, the recent low for the S&P 500 was something like 3,900. So we're up more than 5% off of that. Are you looking at that as a potential stabilization level? Are you thinking we have these hiccups along the way? You talk about the sentiment being poor right now, but in actuality, the fact that it is possible that the markets have had their near-term bottom?
Very possible. And we were waiting and waiting for it. Now, the four sell-offs, major sell-offs we've seen now in 2021, 2022, again, it's only been since January all-time highs. The four major sell-offs have happened on lower volume and lower volatility. To talk about the VIX, we're at 25 VIX. It's ridiculously low in comparison to the emotion that people have right now. And we needed a bounce. We were so oversold. Now, the second step to recovery is to get that bounce is to consolidate. And that's exactly what we're seeing right now. This consolidation right now between 4,200 and 4,000 in the S&P. If we can break about 4,200, then, you know, we're going to get a little bit of follow through. And that's the third step is we need some follow through. But like I've said, and we've been talking about this for a long, many weeks, is the fact that the VIX is actually declining and each time the stock market makes new lows is a very bullish sign. It's called bullish divergence. And the thing we've got out there are earnings, and earnings start again, after the 4th of July. So we're forecasting for earnings growth of about 4 or 5% again, and revenue growth of about 10%. So the numbers are there, and looking at FactSet, which does this, they're saying that they're expecting 52 weeks out. And right now, the S&P is essentially unchanged in the last year, maybe down a couple percent. But over the next 52 weeks, based upon the earnings projections, they're looking for the S&P to be up 20%.
What are the areas of the market, if there is a willingness on the part of investors to make a move? Because we had a conversation with Liz Ann Saunders earlier who said it's likely that people are still going to be pretty cautious on those hardest hit parts of the market right now, like doubling down on tech or thinking that that's a great place to jump into. Maybe history tells us worth waiting a little bit there. What's your sense of the areas investors would more reasonably move into right now? I mean, maybe it is tech.
Well, yeah, from a risk reward standpoint, it is tech. It's set up from a bullish standpoint. Yes, we've had a little bit of bounce. Now, I'm talking about real tech companies. We're not talking about a lot of these companies that have really had a difficult time because they don't make money and they were more of a hope and a dream that eventually they'll turn the corner and be profitable. So those have suffered. But I think there are a lot of real tech companies that Facebook, for example, it's bottoming out. And you've seen Apple as far as, from a value standpoint. I'm an options trader, so I look at options. I'm looking at options right now, September, December, January. So I'm looking to see how the markets sort themselves out over the next 6 months. But I remain optimistic, and I'm extra encouraged by the fact that very few people have seen this market and have any confidence in it. And that's typically when you see a move in the opposite direction of sentiment. So let's see what happens here. I think from a risk reward standpoint, from a trader standpoint, There's a lot of upside potential in so many sectors and stocks. Obviously, the energy sector has done very well, and every time it's pulled back, that's been an opportunity. But I still like a lot of these big name tech stocks that kind of been forgotten about a bit. People will look at this and say, I should have bought when the market was down, but people never do. It's a psychology that amazes me that year after year, decade after decade, when things sell off, people don't want those stocks that they said they do always want to buy when it pulls back, but people never do.
So let me kind of use sort of a similar question tied to that for energy, which you referenced, because the fact that we've seen such strong performance in that sector is one of the main reasons why the Canadian market has outperformed the U.S. markets this year. And you have a chorus of oil bulls who will come on BNN Bloomberg, and they'll talk about the valuations of these companies. Even though the stocks have had big run-ups, they'll sort of paint a macro picture supporting the case for crude and say, look, you should be thinking very seriously about these names. What is your general sense on people moving into stocks that have already had a big run versus what you were alluding to there of people shying away from the stocks that just are getting no love right now?
Right. It's two ways to trade. Now, as far as the energy stocks, like I said, I'm waiting for a little bit more of a pullback in some of these, but I love these longer term as well. 3 years ago, nobody wanted any energy stock. Zero. Now, they have performed, but they still have a ton more upside. If you look at their PE ratios and compare them to a lot of the, history, and crude oil would have to get to $205 a barrel if you adjust the 2008 high for inflation to make new highs. So we still have a lot of upside. But more importantly, for me, I use oil as a barometer of how strong the economy is. And, here at 120, things are still humming along. People have money. People are making more money, and people can get a job, any job they want now. So it's a very unique problem that I don't think turns into a recession. I don't think it takes a economy that's too strong and crushes it. That just doesn't make sense to me. That's not how things happen. But as far as energy stocks, you have to be careful of the fact you don't want to buy in the extreme high, even though that is a strategy, that you want to be buying when they do pull back and then come to some support level and see how they react from there.